Welcome back. Treasury Secretary Janet Yellen rebranding Biden's economic agenda as modern supply-side economics in a speech to the World Economic Forum. Yellen said that rather than tax cuts and deregulation, she seeks to increase labor supply and improve things like infrastructure, education, and research. Joining me right now is the former Council of Economic Advisors Chairman and Managing Director of the Lindsay Group, Kevin Hassett. Kevin, it's great to see you this morning. Thanks so much. You are doing a great job there at the Lindsay Group. Give us your assessment of what you heard from Janet Yellen.
Right. Well, you might recall modern monetary economics was floated by the Democrats back when they were planning to spend billions and billions or trillions of dollars. And the basic idea of modern monetary economics is that the government can just spend as much as it wants because it can print money. And of course, now we're looking at really, really bad inflation. And the inflation's there for two reasons. One, they spent lots of money. But two, I think market participants now think, oh, there are these kooks out there that believe in modern monetary economics. And so their inflation expectations are no longer anchored to a belief that future policy is going to be smart. Well, what Janet Yellen did is that she threw gasoline on the inflation fire at Davos because she basically came out and really doubled down on modern monetary economics, arguing that supply-side economics should be modern as well. And if you look at the context of what she's saying basically it's supply-side economics for the government to spend trillions of your dollars on just infrastructure, on giving free daycare to people. That she had like some kind of convoluted reason why it is supply-side economics, because more workers will go to work if their kids get to go to daycare and so on. But really what she's doing is just making another big excuse for Build Back Better and doing something even more aggressive than modern monetary economics to decouple people's expectations about future inflation. And so inflation expectations aren't anchored, and without them being anchored by the belief that policymakers won't be stupid, then there's no telling how high they could go. And I think Janet Yellen just really did a disservice to the global economy.
Yeah, I mean, look, what's that saying? You can't put lipstick on that pig. I mean, you could dress up this agenda as much as you want, put lipstick on it, but at the end of the day, the outcome is the outcome. And we've got some bad outcomes to talk about. Inflation at a 40-year high, and then the major companies competing for talent. 4.5 million people left the workforce in November. Yesterday, we heard from Deutsche Bank. It is weighing an increase in its bonus pool of about 15%. Bank of America rewarding almost all of its employees with a pool of $1 billion in restricted stock. I spoke with both Bank of America CEO Brian Moynihan and J.P. Morgan CEO Jamie Dimon about the tight labor market right now and what they're seeing in terms of the pressures. Listen to what each of these titans of banks told me in the last few weeks. Watch.
Yeah, so here's the amazing thing. With all we talk about the supply chains at Omicron, we're having all this growth with supply chain problems at Omicron. And that's the way I would look at it, not the other way around. And I think it's just slowing down the growth and slowing down the recovery, but you still have a very powerful economy underneath. And yeah, it's probably one of the first times in my life there's huge pressure and wages and people.
Importantly, we have been on a task to make sure that we are the best place for employees to work. So our core employees have gotten high single-digit wage increases year after year after year. We're in our last year we did our fourth straight year of company-wide bonuses and company-wide stock. We continue to drive the ownership of our company towards our employees to give them a chance to participate in our success. So we believe this is broad-based. Now, when you go talk to our clients, wage growth and the inflationary aspects of wage growth and the pressure that puts on their margins is a very serious concern, and I think that's what the Fed has to start to work on.
So, Kevin, what's your assessment of what's going on in terms of the labor market right now? You heard them. They've got huge pressure on wages and on people. And by the way, even though they're raising wages, it's not enough to keep up with inflation.
Yeah, that's right. If you look at wage growth, real wage growth over the last year, it's as negative as we've seen in 40 years. And so what's happening is that wages haven't kept up with prices. People, you can see it in the sentiment data, feel like they're worse off because they are, because after they're at the gas pump and after they're at the grocery store, they don't have any money left. But what happens now, and you're too young for this, Maria, is we're going to see a wage price spiral. So wages are going to start to respond to prices, and then firms are going to have to pass those price increases on to customers with higher prices. And before we know it, inflation can get double digits and stay there. And the only way to fix that is for people to be confident that policymakers aren't going to be goofballs and that they're going to take inflation seriously. And Janet Yellen's speech at Davos did the exact opposite.
Yeah. So what are you expecting today then, Kevin? You've got the Federal Reserve ending its two-day meeting today, and we'll hear from Jay Powell at 2 p.m. What are your thoughts on what we'll hear?
Right. Well, I think they're going to say that they're going to move at the next meeting, and my guess is that it'll be clear from the language that there's going to be 4 moves at least this year. If it were me, I would vote to move today because inflation is so high. I think the market kind of needs a jolt. I think the market's been a little bit afraid of that kind of action, and you'll probably see a sigh of relief if they say, oh, for sure, we're going to move in March. You know, if they move today, then probably you're going to see more downward pressure on equities. But there's something that people need to know as they watch all of this turmoil in markets, and that is the history of this is that the markets are forward-looking, and that when the Fed starts a rate increase cycle, that by the time the first move happens, the equity markets are done correcting. And so if it really is March when it starts, then you might see another 10% drop this, between now and then. But after that, equity markets usually in a typical rate hike cycle go up about 10%. And so I think that we are close to the bottom. And if the Fed moves today, the bottom's going to be a lot below where we are. And if they signal they're going to move in March, then, we'll be a little bit more downward pressure between now and then.
Yeah, but I know. But Kevin, I mean, how are they going to start tightening when they're not even done easing? Right? I mean, isn't it true that as we speak today, they're still buying securities? They've ballooned that balance sheet all the way up to $9 trillion. They've got to wind down that balance sheet before they can start raising rates. So there's that question. And then my other question to you is, if you know that we're going to see 4 rate hikes, 5. We spoke with your colleague the other day, Larry Lindsay, and he said to me, look, the markets are going to react and they're going to have to pause after 2 rate hikes. If we're expecting that much tightening, why wouldn't they just do 50 basis points instead of 25? What's your take on those 2 questions?
No, that's what you would do. That's what I would do. But I think that they're going to be a little wimpier than we are. And one of the reasons is that the Fed staff has models that shows that every little bit of thing that they do causes a massive economic disruption, which I don't think is true. And so for me, I agree with you. I would do a big move today and then say I'm going to do more big moves if I don't see inflation coming down. But they're going to instead say, March is when it's going to start. Pretty sure.
All right. Kat, yeah, and 25 or 50, the first move?
25. Almost
Kevin,
for sure.
It's
just they're going to be cautious.
Thanks, sir.
Yeah, thanks.
We
Good to see you,
appreciate
Maria.
it. Thank you so much. Kevin Hassett, the Lindsay Group, doing a bang-up job.